Hello all, this is Engineering back again, and I'm going to be talking about portfolio asset allocation. So just a quick background, right now you can see from my net worth statement that I am about 38% in cash and 62% in equities and or alternative investments. I put cryptocurrency in the same state just because it's an investment. Technically, right now, I have a high amount in cash just because of my job employment status, which is as a contractor, which means that the fire at will is possible. And because of manufacturing downtown, the chance of me losing a job and being left with no income is much higher. So here is my portfolio asset allocation. I invest solely in index funds except for gold. Gold, I have to invest in a trust because there is no index fund currently. Vanguard itself only offers a index fund of mining companies that are specialized in mining gold. And because I don't think that is an inherent good investment since it does not correlate with the returns of gold. I invested in Granite Shares Gold Trust, which is relatively new ETF that they basically what money you put in, they buy the amount in gold. So that's how much I have in gold. So one of the things that you can see from my asset allocation is that I am diversified in small cap, mid cap, large cap, international, and then 5% in gold. 0%-ish is in cash in the portfolio itself because I don't have a lot of cash in the brokerage accounts. This includes Roth 401k, and then the regular brokerage accounts. I have these all moved in index funds right now. And one of the reasons why I use index funds over ETFs is because index funds allow automatic rebalancing, which makes it easier to rebalance than the ETF because the ETF does not allow automatic rebalancing. Now, the problem with that is that the index funds actually require, especially if you get Admiral shares, which means lower expense ratios for Vanguard, it requires $3,000 minimum investment. So there is that caveat where because you have to invest $3,000, you usually don't have you can invest slowly with index funds. So what I do suggest is that if you don't have $3,000 right now or at the beginning, you invest with just the regular ETFs. So instead of something like this, VFIAX, you are investing in something called VOO, right? The Vanguard 500 index. Now this is the Vanguard 500 index index fund Admiral share, right? But you can just invest in the ETFs, right? And then you can see they have here. Now the stock connector is a free online Microsoft add-on that you can add to Excel that has real-time information for the stocks. This is just so that instead of using Google Sheets, which if the reason why I don't use Google Sheets is because it doesn't have a lot of the functionality that Excel has. No pivot tables, so you got to do a lot of the stuff manually, and therefore, or you got to hard code it. And the stability issues for Google Sheets I don't really like, and I work with Excel more, so I prefer Excel. And this will update the prices every 1 hour. I don't think you really need every because by default I think it's every 15 seconds or 15 minutes. You don't really need that much updating since if you just look at updating, you'll waste a lot of time. But this is what I use for getting the price of the stocks. I have the quantities that I actually just obtain from my brokerage accounts, and then this calculates total volume from the equations, and then category mid cap, and then Roth US type of account, and then tax type. So right now you can see my investments 89% has no future tax ever. So I paid all my taxes for those. And then 11% still has capital gains and future tax still in it. And then if you're wondering why I have a lot of small cap, because mid cap, small cap, right? VOO is this one, so that's the large 500 US companies, is because in long term, small cap and mid cap always outperforms the large cap. The problem is that because they're more volatile, you should only pick small cap and mid cap only if you have a long time horizon, preferably 20 years plus, and that's what I have. Now, I'm invested in value because I think I'm making the bet that value is going to outperform regular, which it has. So that's not really a bet if historical returns of over 80 years suggest value outperforms regular. But growth. Now, growth in the past 20 years has outperformed value. My research on that indicates is that growth has outperformed simply because of unlimited borrowing, because of the Federal Reserve can print unlimited money right now, and what's happening is a lot of the zombie companies such as, well, not zombie companies, but companies that use large debt to finance operations such as Uber, such as Tesla. Now, Tesla is changing, and you can see that when a growth stock starts to become a value stock or starts to become a regular stock, you can see a huge amount of capital appreciation, which means everyone noticed that Tesla stock went from like 200 like 1.5 years ago to almost 600, or it's 600 plus now maybe. I don't pay attention as much. But that's just simply because when a company starts from no capital to profitable, then it basically can be a company that lasts for long term. Now, preferably, I would never bet against Tesla because you can't really bet against a cult. So therefore, I would not suggest you short any stocks. So I go only on long because that's all I know, and I have mid cap growth because I do think that mid cap, which is usually considered called momentum stocks, which means stocks go from small to mid to large, right? And then mid cap has high potential returns from growth. So I did have a little bit. Now it's not a lot. We're talking about only 3,000 out of 66, so that's about 4.5%. So not that much on growth. My small cap value is situated at much higher in terms of mid cap value, and now large cap I just do the 500 largest, so that's basically solely based on market cap weighted. The federal funds is the money I have in those federal funds. This is Granite shares called BAR if you want to look it up, gold ETF. Total international, I have it simply for the sake of having international diversification for my portfolio. Now, the research indicates that international should do better this year than last year because of US outperformance last year. This might be true, this might be false, but we will see. That's why I increased it. Before it was about 15%, I increased it to about 20% of my portfolio. The rest is the same thing, mid cap growth, mid cap value, small cap value, total international. So a lot of these are repeated and they're based on this portfolio asset allocation, which I aim for 20% international, 5% gold, 25% large, and then roughly around 50% tilted towards small cap, mid cap. But 50% of those is small cap, mid cap, and that's how I give my portfolio asset allocation. So you can see my total numbers, of which right now about $58,000 are never taxed, so that's going to be helpful later on. And 7,200 is in my regular brokerage account, of which it just has the Gold Trust. And that will be for my video. So this is just to talk about asset allocation, why I do index funds, and what you should do. Now, I do suggest that if you do want a simple approach, would be simply put, just get 20% Vanguard Total International, and then 80% Vanguard Total US Market. And that will give you small cap, mid cap, and large cap. But it will be situated based on market cap weighted, which means that it will be about 80% will be large cap, about 20% will be mid cap, and then 5% will be small cap. So you won't have as much tilt towards smaller mid cap, but you will have a globally diversified portfolio. So thanks for watching, guys. Like and share, subscribe if you want to see more, and I will see you next week.